Hey, good afternoon or good morning for folks on the West Coast to the Q2 2023 Richie May Mortgage Trend Series. This is Seth Sprague, substituting for Nathan Lee today, who's couldn't get bandwidth to join us. If you remember from last time, he was very scenic in Louisiana with birds chirping. I am not on video today. I'm actually up in Connecticut. Visiting my mom. But we have a very exciting trend series for you today. We've got a couple special guests in addition to Molly, who will be doing the benchmarking. We're going to be joined by both James Brody and Mike Kelleher to talk about repurchases. So as folks know, Richie May's long-standing trend series where we're trying to provide some benchmarking data to folks. And for those that don't know, Richie May, obviously we do a lot of audit, tax, and consulting work in the mortgage banking space. Over 35 years, Richie May has been around. And, we really do try to provide these calls as a service to our customers and potential customers, just to give them some insight about some of the great benchmarking we've got. And as I said, this is going to be a little bit of a special trend series where we've got a couple of guest speakers that we're going to talk about repurchases, trends in repurchases, market values around repurchases, ways to fight repurchases. So once we get through Molly's presentation, I'll kind of be moderating a panel with both James and Mike on it. So as you know, we're focused on mortgage. And with that, I'm going to turn it over to Molly, who runs our data and analytics team here at Richie May, and she's going to be presenting. We will have, just so people know, we will have 3 questions for CPEs that you have to answer as you go through that, and this is being recorded, and the recording will go out after that. So with that, Molly, I will turn it over to you, and you can start on the benchmarking. And remember, for those CPE credits, you need to answer all 3 questions.
Okay, Great. Thank you so much, Seth. So we're going to go ahead and start with a poll question. So the first poll question is, how are your Q2 margins compared to Q1? And you just want to select one, so declined, flat, or improved.
As we mentioned a minute ago, these are the poll questions that are required if you're looking to gain CPE from this webinar. So if that is you, please be sure to get your response in. We'll give it like 10 more seconds or so.
Okay, thanks for the feedback, everybody. So it looks like the majority of folks, just by a little bit, say margins are flat for Q2 compared to Q1. So I guess we'll go ahead and see how that holds for the remainder of this quarter, but we're going to get started looking at Q1 numbers. Okay, so today what I'm going to be going over is Richie May Select. And so anybody who might not be familiar with, myself or my team here at Richie May, my team is responsible for several benchmarking and analytic offerings, including Richie May Select, which is a quarterly financial benchmarking program. We started Select over 10 years ago, and we have about 70 IMBs participating, and each quarter they submit their quarterly financials, and then they can see that in comparison to different peer groups, which are based on various size and channel mix. So today we're going to be looking at results from Q1, which we just released. And so we'll look at some origination trends and then some key financial metrics. So overall in Q1, to give you a bit of a preview, we did see a decrease in production volume. And then we did see a decline in net production income, but GAAP net income did actually increase this quarter. And then we saw cost to originate on a per loan basis increase again this quarter. So again, something to keep in mind is we are looking at the entire population of Richie May Select participants, which does include companies of, all channels, sizes, etc. So we really want to focus on trends or movement in averages over time. So we're going to start off with some origination trends. So here we're looking at average production in terms of volume over time. In Q1, production volume was down about 10% on average compared to Q4 of 2022 and down about 56% on average from Q1 of 2022. So I'd say the decrease, in Q1 was expected given, the continued volatility and uncertainty that we've seen in rates as well as other market factors. So we did see a decrease in both purchase and refinance volume. Purchase production was just above 90%, which remains kind of that high watermark in program history. And then another attribute is that we did see a decrease in weighted average note rate in Q1. We saw a drop of about 15% on average over the quarter, down to about 6.3%. And again, that's over the entire quarter. And that is notable because, of course, it's been a while since we've seen a drop. The last time was in Q3 of 2021. So next, we'll go ahead and move into some financial trends. So we're going to start with net income and net production income. And for the purposes, of these metrics, net income is that GAAP net income, that audited income statement, and net production income is really our number that's intended to show that origination platform profitability. So we're taking that GAAP net income and excluding a few different items. So we're removing items not related to production, such as anything related to servicing, so income, expenses, etc., and then any outside activity or investments. And then we're removing unrealized gains or losses over the quarter, such as unrealized gains from your unfunded lock pipeline. And that gets removed from our secondary gain on sale number. So really this number, this NPI number, is meant to give you more of an apples to apples comparison. So you can see on the chart here where we're looking at program history that both numbers were still negative, and it was the third consecutive quarter of both negative net production income and net income. But the gap between the two numbers did compress to about 20 basis points in Q1. So net income was down about 10 basis points on average in Q1. So that net production income number was negative 109.3 basis points. And that was really driven by a couple of factors. So we did see an increase in cost to originate in terms of basis points. And revenue was up marginally, but not enough to offset those increased costs, which we'll dive into later. So on the revenue side, we did see a slight increase in secondary gain on sale, but that net warehouse spread was down significantly in Q1. And then when we look at that GAAP net income, although that was still negative in Q1, it was actually up compared to Q4 of 2022 by about 54 basis points on average for that entire participant base. So net income was negative 89.1 basis points. And the increase there was driven largely by increases in unrealized gains over the quarter, which are taken out from that net production income number. And then we also did see some, increases elsewhere in revenue. For net income, total expenses were also up, but really only marginally overall, which also helped increase that overall net income number. So now we'll dive into NPI, gain on sale, which is really intended to show, again, those realized gains and losses over the quarter, which plays a really significant role in that overall NPI number. So here we have an average of all select participants over time, so looking at lenders of all shapes and sizes. And although the Q1 number was up slightly. It's still low compared to historical averages, but secondary gain on sale was up about 2% or 6 basis points on average compared to Q4. So again, we're just showing realized gains here, removing any of those unrealized gains and losses on unclosed interest rate lock commitments and then open hedges. So finally, we're going to look at cost to originate, which I mentioned at the beginning. Cost to originate on a per loan basis is up, on a dollars per loan basis is up in Q1. So here we're looking at expenses just related to origination, so removing anything related to servicing or any of those outside investments. And then we're dividing that number by closed or by funded loans over the period. So we did see another increase here. Cost to originate was up $629 on average compared to Q4, which is up about 4%. So this is the highest cost to originate that we have seen on a per loan basis. However, when you look at expenses in terms of dollars, those were down in Q1. So costs were up on a per loan basis because of that continued decrease in production. When we look at total costs, that decrease was really driven by, continued cost saving measures, such as continued reduction in headcount, which we did kind of see across departments. And when you look at headcount in total, that was down about 9% on average from Q4. So we're still seeing decreases there. And then if we go back to cost per loan, when we look at both personnel and operational expenses, we saw increases. With personnel, we saw increases across departments. So sales was up about 1%, your fulfillment role cost was up 2%, and back office was up 14%. And then ops or overhead expenses were up only marginally or really nearly flat, so just up 0.1%. Notably, we did see a decrease in advertising and marketing expenses, but that was offset by smaller increases in other areas. So, overall in Q1, we continue to see similar trends that we saw in 2022, especially in the last half of the year. But on average, the shifts that we saw in Q1 were a bit less dramatic. And then looking to kind of this year, so far we've still seen some volatility in rates, but in recent weeks, we've seen more of a flattening trend, almost a bit of a horizontal trend, which is certainly, a welcome departure from last year. And then, going into the rest of the year, I expect there to still be some continued uncertainty, but I'd say there is some hope for a more positive trajectory of rates. So yeah, I'll go ahead and pass things back to Seth, and thanks everybody for your time.
Molly, awesome job, and thanks for all that wonderful data. And just kind of to summarize everything, it's still not the bestest news out there, but the trend, and I know folks that are on the origination side, there is a hypersensitivity to rates today. So a 630 week of rates versus a 650 week of rates is dramatically impacting the volumes that people are getting. As Molly mentioned, the staff cuts are continuing, but we do at least appear to be off the bottom when it comes to the origination volume. I think the biggest concern that I know, I talk to a lot of clients, I know Nathan does, I know the entire Richie May team is always out talking to our clients, but the biggest problem out there continues to be a lack of inventory. And so that purchase market number is very contingent on people willing to sell their homes. And there's certainly a residency or unwillingness for some folks to get rid of those ultra low mortgage rates. So thanks, Molly. Great information. If you got follow-up questions, please reach out to anyone on the Richie May team here. And as we're going to pivot now to our two special guests here, I'm going to introduce James Brody, who is a senior partner at Garris Horn. And, he comes on our panel here with a wealth of experience, specializes in the mortgage industry, around mortgage litigation and support around repurchases, which I know is a very hot topic, and he will walk us through some slides. And I also would like to introduce Mike Kelleher, who's a senior director at Sidus AMC. For those that don't know Sidus AMC not only provides MSR valuations, but they're very active in buying or helping advising folks in selling MSRs and whole loans, and in particular, they are very active in the scratch and dent market. So he's going to be able to provide us some color here. And so without further ado, I'm going to hand it over here to James. But before we start, James, on your slides, I'm going to ask you kind of a softball question. But for those of us with gray hair, we've lived through the 07, 08, 09 meltdown. And obviously repurchases are another hot topic again today. So, I guess my first question as you kind of walk through your material is this a repeat, a rinse and repeat, or does this feel different to you, knowing that you've lived through both of those cycles?
Well, thank you, Seth. At the end of the day, repurchases will always go up when rates go down. I mean, that's been the trend. However, there is, a key difference or key differences between what happened in the meltdown and what we're seeing today. Because prior to the meltdown, what was happening was we were dealing with all the stated loans, Nina, Neds, Visas, what have you, or, as many people call them, liar loans. 90% of the buybacks and the litigation, over them had dealt with those stated income and stated loan products. Now we're not dealing with those products. We're dealing a lot more with various underwriting issues, processing errors, compliance issues. And obviously the reason it's picking up is because people are trying to protect their own profits. They're looking at the writing on the wall. They're looking at what's happening in the industry, and they're trying to clean up their books. And then, of course, you have, like I mentioned in this slide with regard to the counterparties, previously when parties like Citi Mortgage had gotten out of the business or others have gotten out of the business, they sort of lost that relationship attitude, and they were trying to really just clean up their books. Right now, we see that Wells Fargo's gotten out, and although we haven't seen many or as many repurchases from Wells as we might otherwise expect, we are seeing more, from various players, and most notably that I guess would surprise a lot of people is that the FDIC, when they had pursued a lot of lenders, it used to be for IndyMac and others, and now they're actually going after Old Washington Mutual related loans. They've filed about, I don't know, maybe 6 or 7 lawsuits in the Central District of California. And, given my understanding that their statute of limitations might be running this September, for all those people who had received letters from them, they could be looking at getting brought into this litigation. But unlike Lehman, it's probably more like the RFC ResCap litigation in so far as numbers.
Wow. So the revenge of WAMU loans continues.
It's just the gift that keeps on giving.
It is. It's the Jelly of the Month Club. All right.
And so let's go to the next slide here. So, aside from the trends and what we're seeing the differences and obviously with the pandemic and people now starting to get caught up, especially at the aggregators as well as the agencies, things are moving in the repurchase direction. More and more repurchases are coming, but it's certainly not going to be the number that we saw back in 2008 through 2014, 15. How to avoid these demands, though, going forward, because when I talk about avoiding them, it's not really much you can do on past production, but there's a lot that you can do on future production, and which really should be done, and we haven't seen a lot being done by many in the industry. Now, I think everyone understands that they should diversify their investor deck. I mean, at the end of the day, last thing you want is to get in trouble with one investor. You're selling 70% of your volume to them, and they've got you, right where they want you. I mean, if you don't go ahead and play ball, buy back the loan, indemnify them, your business is on the line. However, if you properly diversify, if you have one problem with an investor, then you have all your other investors who you can reroute your production to. So that's just more of a common sense tip. But with regard to contract negotiations, I think that's where many people don't do as nearly of a good job as they could do, because a lot of people don't think that the investors are going to be willing to change the language in their investor agreements or their mortgage loan purchase agreements. Well, I can tell you, although my experience is that there is actual leverage if you are selling a lot of volume to one, and they'll make more changes for you than they might some others. Even if you're a small mom and pop shop, let's say you ask for 40 changes and they're willing to give you 3 to 5 changes. Well, I mean, you may not get everything, but at the end of the day, you're still going to end up with a better contract than you had. And that could mean the difference between you getting pulled into court. It could mean the difference between you having to pay out a lot of money and the difference of not having to do so. So those are really a couple of the tips, but more on the contract negotiations, I believe, on the next slide, please.
And James, as we transition to the next slide, there is, if I'm trying to sign up somebody new, does my past experience help me sort of get more of those 40 things? Are they looking at my past performance as well that can help me in this negotiation?
I haven't necessarily seen that. However, certainly they're going to evaluate you and what they think kind of entity you are. I mean, do you look like there's going to be problems, things aren't done properly, maybe a little sloppily? They could look at your history, but hasn't really been involved in the negotiations that I've had. And I've probably negotiated with these MLPAs and seller's guides with most of the major aggregators out there. And what I can tell you is that there are certain things like pre-08, it was fairly common in MLPAs to have a knowledge qualifier where you wouldn't be responsible for an indemnification or a repurchase unless you knew or should have known about the issue. Now they strip that away. It's effectively strict liability, although there are ways to go ahead and soften that up. And with regard to, as I put here, the indemnification provision, this is a huge part of what needs to be looked at. The indemnification, the repurchase provisions in your MLPAs are where you really want to be focusing, your time. You should try to obtain a provision that allows for a notice and opportunity to cure, or if it's already there, an increased time period for that notice and opportunity to cure, because as you're getting busy, things are heating up. The last thing you want is to be under the gun to try to get information off to an investor on something like this without giving yourself a proper period or frame to be able to do that. With regard to repurchase, EPD may be a repurchase or only maybe a fee. Certainly you want to talk about a fee. This sole and exclusive discretion language, I've litigated that a lot in the courts. And it's something that investors love to throw in. They have the sole and exclusive discretion to basically kick you around. And what you want is a even, fair contract. At the end of the day, especially coming from the lender side, if you're going to do business with someone, you want to know that you're going to be treating each other equally, and you're not going to be in a position where, like I've seen some contracts, and I tell clients that these are deal breakers, at least I recommend them to be deal breakers, where an investor says, you agree to waive any and all of your legal rights or legal defenses. So even if you were in the right or the investor did something to add to that, they go ahead and are able to push that loan down. And again, it comes down to an evenness, fairness, and reasonableness. With regards to the offset net funding provision, again, notice, ability to cure, things that will give you more time, more leverage to try to get a resolution outside of court is going to be beneficial. And then finally on this slide, with regard to unilateral attorney's fees, the big issue here, having litigated probably 60 or 70 of those Lehman cases, was that when we got involved in negotiations, Lehman's position would be, hey, if we win, you have to not only pay us the damages, but you also have to pay us our attorney's fees. However, if you win, you don't get your attorney's fees, and you walk out, I'm going to pay a lot of money to your attorney. And so, again, that doesn't give you some proper leverage. Depending on the state, they may not interpret that as being unilateral. New York does, California doesn't, and other states are somewhere in between. So that's a few of the tips on the contract terms, but I think there might be more if you turn to the next slide, please.
And as we go to the next slide here, again, given the fact that margins are down, staff levels are down, that timing that you could try to get to fight these is incredibly important for people, right? I mean, when you've got staff reductions, you don't have the ability to fight these. And then as you're losing money on your current originations, you don't have money to fund these. And so how much of that angst are you getting from your client base now with, they're kind of throwing up their hands, James, going, James, I just need help because one, I can't afford to fight them, and two, I can't afford not to repurchase them.
Right. Yeah. I mean, look, in some cases, you're damned if you do, you're damned if you don't. Nevertheless, depending upon what their resource level is, we try to work with them. If they have the internal resources to do some of the work, do some of the, digging, we'll work with them to try to save them on fees. But at the end of the day, if they need that help and they need to outsource the process, we're always there to help them out. And in addition to the time, I will mention materiality language. Anywhere you can put materiality in the contract is great, because what that means effectively is, look, I know that there was a problem, but this wasn't the type of problem that would have caused this deal to fall through. And don't hang your hat on something that is, at the end of the day, important, but really inconsequential insofar as whether the deal would have been consummated. And the other part, one of the big ones, is because the seller's guides change all the time, and these things are huge, thick. Last thing you're going to know is every time there's been a change to a seller's guide, unless you have someone sitting at the desk reading over this thing all the time. And so what I say is, because you can read over the 4 or 5 pages of an MLPA, always put in the agreement that if there is a conflict that comes between the terms of the MLPA and the seller's guide, that the terms of the MLPA will control. That way you always know at least the most essential terms. At the end of the day, no matter what happens with the seller's guide, you're still going to have the benefit of your bargain by using that MLPA language. So, and then, really, as far as what else they can do to avoid the repurchase demands, simple things like make sure that your underwriting staff are fully trained, especially for some of those more complex loan products and situations, and that the investor and program requirements are being met, because we're seeing a lot of the repurchases come up as a result of that. And then with regard to where I say outsourcing your underwriting, one thing that people do all the time is they come to lawyers, want a legal opinion, because that effectively is buying another insurance policy. If a lawyer gives you the wrong advice, well, he or she has an E&O policy. The same thing with getting outsourcing any vendor, making sure that they've got insurance coverage. Why not go ahead and give yourself an additional hook to go after someone else's pocket if you ultimately get caught and have something to do with what they did or didn't do. So next slide, please. All right. Preparing for the repurchase demands, loan loss reserves and reps and warrants insurance policies. Look, given the uncertainty and the volatility, it's always important, and this was something we dealt with a lot back in, the time of the meltdown, is what level of reserves should be set. And, making sure that if something comes up on one of these rainy days, that you're going to have enough to make sure you're able to pull your company through that challenging time. What the level of the reserves are, it really is dependent upon the business. I mean, people are, some businesses are willing to take more risks than others. I tend to think, I'm somewhat conservative. I would like to have a nice cushion there in case there's a problem. But again, if you need to utilize that money to keep your business afloat during this time of volatility, you got to do what you got to do to stay alive. But if you have a choice, I would say to always look at erring on the side of, having more reserves rather than less. You should also consider, when you're making that calculation, look at your risk, look at what's happened in the past. How many repurchases have you received? Have you had a lot of problem loans? And again, err on the side of being conservative. And then with regard to the repurchase insurance, I think there's a few policies out there. When I got my start in this business, it was as a subrogation counsel. So the insurance companies would retain me to defend the lenders against buybacks, and then to pursue all the third parties to collect the money back that the insurance company had to pay out, as well as what the insureds did not receive under the policy. So all I would say is that, instead of advocating for one or the other, I would just say that whatever insurance policy you're looking at, you ask about the number of claims that have been made, and you ask the number of claims that have been paid, and try to give yourself a little bit more information to see how that might play out if you were to obtain a policy. Next slide, please.
And in the shameless plug department here, as we go to the next slide, James, on the reserve, make sure Jennifer Hanna and the audit team at Richie May is aware of what you're reserving for, and it's reasonable and estimatable. You and I are not allowed to give accounting advice. I know I'm not. You may be closer to being allowed to do it, but it is something that people do you should have this. And I'm just going to draw one other conclusion here before you go to the next slide here. But
sure,
when we see through the M&A practice, right, mergers and acquisitions, a lot of times you're seeing these liabilities being left behind with the company, and they're not acquiring these reps and warrants, right? So this has implications when you're thinking about M&A as well.
Oh, yeah. Well, our office does a lot of M&A, and, one of the big things that we do in the due diligence side is dealing with, what you can do to protect yourself on those buybacks. Sort of looking, if we're looking at an acquisition, we're taking a look at what their repurchase exposure may be, taking a look at what problems they've had. I mean, all of that goes into the pricing, the deal points. Repurchase issues and quality of production in any M&A transaction, you always should take a look at that, and you should always consult your broker, insurance broker as well, to see if there might be any policies that can, help with any tails. So it's an important point that you made.
Very good.
With regard to and on the defense side, so we talked about the trends, we talked about avoiding them. Well, what do you do about the past production that's coming back to you? How do you defend against these repurchase demands? And anytime you receive such a demand, and it's based on the breach of the reps and warrants and covenants, the first thing you should always look at, above and beyond the facts, which you obviously have to do, is take into consideration your relationship. I mean, if the investor's asking you for $20,000 and you're making hundreds of thousands of dollars off that relationship, well, you don't want to cut off your nose to spite your face. I mean, you even if you might be right, if it hurts you to stand on principle, well, take one for the team and do the business. If you have a great investor and they're asking you for $1 million, well, then we're talking about a different problem, because, if you don't defend against that, it could mean that whether or not your company survives. So take a look at the importance of that relationship that you have. I mean, obviously, if you get Fannie or Freddie direct, I mean, you just, with an SOL, I mean, you push back, and usually they're pretty good about working with you. But at the end of the day, if they say jump, if you want to stay in business, the answer really needs to be how high. Now, evaluate the nature and extent of the damages, the strength of your factual and legal rebuttals. So here is just common sense. Once you get the demand, you have to look at what they're alleging. You have to evaluate whether it's actually, in fact, correct, whether there's any defenses. I tend to say that it's good to outsource that to your lawyers, because if you get caught up in litigation, there is a big question about everything that you do in-house, whether that will be discoverable. Maybe you find bad facts and you have to produce that, and you're just helping bolster the investor's case for them. So there are things that can be done, like, let's say there's an appraisal issue. Well, I would go ahead and order a retro review appraisal. If it came back bad, I would put it under, attorney work product and protect it. If it came back great, then I would submit that. So there's some benefits to having things ordered through counsel because if you order it yourself, and again, you get hit with litigation, well, you may very well have to provide that and put the nail in your own coffin there. As far as requesting documents, information, a lot of investors, will provide some, but a lot try to stand on this issue of privacy. Well, I made the loan, I sold you the loan, and you're telling me that you want me to buy the loan back, but you don't want to provide me any of the information about the loan that you want me to buy back and I originated because of privacy. Well, the long story short, not to belabor the point, is that the GLBA has specific exclusions that protect you from those privacy type issues. So really, you should be asking for servicing notes. Always ask for servicing notes. See what was going on with the loan. See if there was a problem there. Ask for a proof of the losses, how they got to the losses. Did they fire sell the property? Did they get a good valuation and win on that? So get the information and documentation that you need, and because you are on a limited time frame, try to ask for that information as soon as you get the demand, so that you give yourselves or your counsel enough time to really give you a full and fair evaluation.
Great advice.
Yeah. Next slide, please. Mitigating. Defense. We talked about defending against them. Obviously, we can't get into too many details on those, but how to mitigate. Let's say you are culpable, and there's a problem, and under these MLPAs, a lot of times you are arguably liable the way they're phrased. Nevertheless, if you are in a position where you're going to be stuck with the loan, you want to look at any available third parties, whether that's brokers, borrowers, appraisers, settlement agents, title companies. See who might be responsible for the issue at hand. Is it a valuation issue? Did the broker lie, tell the borrower to say something that wasn't accurate? And on broker agreements, I would say, if I'm negotiating those, I'm going to be standing in the shoes of the investors, and I'm going to want some really hard hitting. I'm not going to want a fair agreement because, I want the same things the investors want. I want to protect my client. So, always look at those. And then on settlement agents, if you're in a closing protection letter state, always try to take a look at your closing instructions to give yourself a hook for additional insurance, because closing protection letters, in many cases, protect you above and beyond simple title issues. Did the settlement agent fail to follow your closing instructions? Was the settlement agent committing fraud, or even the best, or dishonesty? Well, dishonesty is something far less than fraud, at least legally. So that's a way that you can increase your chances of going after a title company and a settlement agent. Get the available documents. Make sure that you put together a good strategy. If you have to go after a borrower, borrowers don't usually have money. So what's the point? There's a lot of risk in dealing with borrowers. But if they committed fraud, usually they'll be able to give you the evidence, the information, and that may be just as good as money if you can utilize that and leverage that to go after other parties with a declaration or some other piece of evidence that's going to point you in the right direction. But again, always thinking ahead 10 steps. If you end up in litigation, the person at your company that's interviewing these people could be called to a deposition and have to testify. Whereas if you do it smartly, you go through your counsel, there may be ways to go ahead and protect some of that information and evidence, unless, of course, it's good. Then we want to sing it, all day long. And then, of course, talk to your insurance broker. I can tell you, like with the scores of Lehman cases, there were maybe only 3 or 4 that had insurance coverage under their E&O policy, because E&O doesn't usually cover repurchase issues, but they were covered. And so it's really important that, and if you don't want to raise it to your insurance company through a claim, your broker has a vested interest in, treating you right. Go to your broker and say, hey, I've got a hypothetical. If this, then that, what are your thoughts? And then, if you have a policy that has a $100,000 deductible and you have a damage level of $110,000, well, it's not really worthwhile for you to go ahead and do that. If you've got a $5,000 deductible and $100,000 of losses, absolutely. So those are just some of the tips that we utilize when we, roll up our sleeves and go after people. Next slide, please.
So James, I know this is your last slide. So when all else fails here, we end up with the repurchase, right?
Yeah, I mean, look, you do what you can do to avoid the liability. You do what you can do to defend against it. At the end of the day, there's not 100% wins, and so you need to take a look at. There are ways, though, to try to get better resolutions than others, and this comes down to settlement issues. And I'll give you one, big tip here. If you have 10 demands, you might very well, you might very well get a global release, especially if you're not doing business with that investor anymore. If you've got 2 or 3 demands and you're working with that investor still, they're not going to give you a global release from any and all production that you may have done up to that date and time. But what you can do to sort of back end the global resolution is to put a provision in these resolutions with the investors that says, hey, I'm settling these 3 or 4. Nevertheless, you are representing and warranting in this settlement agreement, which is a contract, that you are not aware and shouldn't be aware of any other actual or potential repurchase issues, because the last thing anyone wants to do is go ahead and do a settlement with 3 or 4 loans, and then 2 weeks later get hit with another 4 that the investor knew about or should have known about at that time. And if they put that provision in there, at the very least, if they do know of them, they're going to say, well, maybe we need to open up our negotiations again because we've got these other ones. And if they fail to do that and they knew about it or should have known about it, then you can use that to defend against having to deal with any of those other buybacks that they knew about or should have known about. So that's one good trick, for anyone that gets these demands, that wants to get them resolved, and wants to give themselves the maximum amount of protection. I think some of these other issues that we had already talked about, one thing I would also go ahead and say is that it used to be much more popular around the time of the meltdown, but if you have a large settlement demand and you've got to go ahead and pay it out, let's say you've got $400,000 you're going to need to pay out at some point in time. Well, and you're still doing business with that investor. Sometimes they may be willing to say, okay, how about I give you guaranteed production of a certain volume over a period of time, and you take so many bits out of my production so that I protect my cash flow, and it's a way that we're doing even more business, and so it's a win-win situation.
That's great advice. I think we're going to move on to it. James, this is wonderful, and I think we have a poll question coming up here if I remember the presentation. But James, kind of to summarize, it's important to get the contract negotiated upfront correct to get the maximum protection that you could get. And then once you get into that contract and relationship, it's very important to do things properly as you get those repurchase demands to make sure that you've got all the parties' information protected. You got the stuff under attorney-client privilege if you need it. And unfortunately, at some point, you may just have to settle. So that was wonderful advice. And we've got a poll question here about what change have you seen in repurchase requests in 2023, less, flat, or more to 2022. But James, thank you very much. We're probably going to get some questions here at the end for you, but we really appreciate you being on the call, and we'll probably loop you back here with some questions here at the end.
Absolutely. Thank you.
And so we got the poll question up, and people are sadly, well, maybe not for Mike, sadly seeing more. I'm going to throw Mike under the bus here. Mike trades these things. So Mike, we're, on the people on the call, we're seeing more. James, that's maybe more work for you as well. But as you highlighted, and one of the things I didn't think about until you mentioned it is, think about those number of correspondents that have gone out of business and all those repurchase demands that they don't have that relationship anymore. And there's multitudes of those folks that are now closed. So
yeah,
we're probably gonna see more demand. So Mike, so you sit here I will say, once these repurchases occur, so what do folks get to do with these wonderful loans when they call you up? What are their options?
Unfortunately, in my day-to-day, there are calls that people are excited to make, but when they're calling me about their scratch and dent loans, it's usually not one that they're very happy to be making. So that being said, you do have options, and While some days it's better than others, there are ways to, again, mitigate those losses. So, building on what James had talked about, incredibly well just before this, the first option that you have, and unfortunately it's not necessarily a great option for everybody, is that you can hang on to these loans. So, in many cases, the repurchase that you're getting is not an issue that truly impairs the quality of the loan. You may still have a loan that is very likely to pay you on time, and it's difficult to sell those into the secondary market for a lot of institutions because they feel that there's not real problems there. So for many banks in particular, or IMBs that may be a little bit more well capitalized, they'll hold those loans in portfolio, right? And you can sit there every month and collect those payments. And overall, I mean, like I said, just because these loans are triggering a repurchase does not mean that they are the bottom of the barrel and you have huge credit issues. Many of these are very good borrowers that you may have missed a minor issue, but the loan will continue to pay. Now, for those groups that unfortunately don't have the balance sheet capacity or wherewithal to hold these loans in perpetuity, and these days with the way rates are and new originations are, you could be stuck holding them for a very long time. So one of the other options that we see people do, and again, with any of these options, they can be dual tracked. So when we say the decision can be made to hold in portfolio, you can also explore your other options of working with the borrower or selling the loan before ultimately deciding to hold the loan in portfolio. So, while I call it the second option, I don't necessarily think that these things have to be done in chronological order, but you do have the option to work with your borrower. I mean, many of these defects are nitpicky issues that don't involve the integrity of the loan. I mean, things like not ordering a second appraisal for a jumbo loan may deem the loan ineligible, but that's that does not necessarily mean that the value of the property isn't there, or there are many other issues that could be temporary related to these borrowers in terms of loss of income or not having the appropriate documentation for the income that they have. So oftentimes we'll see people work with those borrowers and see if they can offer them a discounted payoff on their loan and originate a new one, and that's another good option to sort of mitigate the loss once you have had a repurchase demand. And the final route, and frankly the one that you're probably going to have me more involved in than either of the others, is to sell these loans in the scratch and dent market. And so ultimately this is an outcome that many people face. As you'll see in a upcoming slide, just our company alone sees about $5 billion in UPB every year of these loans, obviously give or take depending on volume. And depending on the market environment, some days these losses can be not all that painful. I mean, going back a handful of years, there were many loans that were being sold at levels near or above par. Unfortunately, like many things in this industry right now, scratch and dent market is impaired. It is difficult, and when you're selling to these institutions, not unlike the agencies or your normal investors, when you're selling them loans at lower rates, the prices are going to reflect that rate. And so as we're seeing these repurchases come through the pipeline right now, it has been a little bit more painful because of the lower rate on most of the loans that are coming through. That makes its way through to the price that you have to take, and unfortunately, ultimately, the loss that you absorb as the seller.
And Mike, before we go to the next slide, you can start talking about the market. But before we go there, so if I hold these loans in portfolio and have the ability to do that, then do I have to get these marked? Do I have to get these valued? I know Citus could do that work for me as well, but can you kind of walk through not the valuation side, but how frequently do they need to be marked? Is there good valuation tools out there?
Sure. Yeah. And Seth, thank you for the plug there. Yes, that is a business unit that we have that is valuing these types of loans, or really any types of loans. But frequency and the source, or I guess level of valuation will depend on each institution. So not surprisingly, banks are going to be the most highly regulated entities, many of whom are going to need a monthly mark on these assets. And many of which will require a mark by a independent third-party provider who can provide a full cash flow analysis. For some institutions that are, maybe IMBs or a little less regulated in terms of, their covenants around holding these assets, they may only need the mark quarterly or annually. And oftentimes, it's an acceptable way of marking the portfolio to put the loans out for bid and utilize the marks that, or I guess the bids that you receive as a mark, even if you do not sell them. You can use that to establish a market value for the asset. So, Seth, in a complete way of ducking the question, I guess it depends on who you are. And what
that's my answer. It always depends.
Yeah.
Excellent.
Great. And so, as I mentioned before, if you do end up with these, problem loans, scratch and dent loans, the one bit of good news is that there's a very robust market for these assets. Again, as you see the numbers here, and we're kind of averaging about $5 billion per year in simply scratch and dent loans. There are a lot of outlets, there are a lot of buyers of this product. So, while you may not always like the price on a day-to-day basis, given the individual loan, you do have options. It's not a particularly difficult asset to find a buyer for. And so, yeah, I think that, when you're out there making those decisions, it's oftentimes good to speak to an advisor, because people who are doing this every day have, more contacts around the industry who are buying these things, and a little bit better idea of who might be a good fit to get you the best price. Because, really, truly, with the different types of entities buying these, the variation in price on the exact same loan can be quite dramatic.
And Mike, from a standpoint of timeline of getting a trade done, if I've got a tape of loans and I get to you and it's May, 18th, 19th, whatever the day is, like, how quickly can you turn bids? How what's that gestation time to get to sale?
That's a great question. So, the quickest portion of the process is getting bids. Most times when we put out a tape for bid, we're asking for offers back within 48 hours. So that's the good news. You will quickly have some options to assess what your next course of action is going to be. From a standpoint of getting to, evaluating and accepting a bid onto the point where you're receiving cash and settling on the loan is a bit longer process. I would say right now, you're looking at generally about 30 days. That being said, it's important to constantly refresh with whomever you're talking to about these loans, because those timelines do vary greatly. And, for the better part of 2020 and 2021, when originations were really robust, a lot of the third-party vendors who are being utilized in these scratch and dent transactions are the same underwriters who are doing some of the front-end origination work. And those vendor timelines really slowed things down. So in a normal market environment, which I would, term this to be, I guess, normal being a relative word, a slower market or normal market, 30 days is what you can expect. But we've seen those timelines swell out to 60 or 90 days, depending on the size of the transaction and what else might be going on in the world.
Cool. Yeah. And now we can talk about your final slide here, kind of pricing or yield. And if folks got questions, please put them in the chat and we'll address them either live on the call here or post. So yeah. All right, so now we've gone to market, we got some bids. So tell me what price I could get exactly for these loans. No, I'm putting it in the spot, Mike. I know every loan's different.
For every loan across the board every time. No, so it's, as you'd expect, the pricing is going to be very, very dependent on each individual loan. And I would say when you end up in the secondary market and are trading these scratch and dent loans, loan level characteristics are going to play a much bigger role in the price you get. Investors in this space are going to be much more punitive around high LTV loans than what you'll find for loans that are going to be delivered to Fannie, Freddie, or Ginnie, and that's because they're on the hook for those losses. So things like FICO score, when you're looking at what feels like a painful LLPA when you're originating for an intended investor, gets much more painful as you make your way into the scratch and dent market. And again, it's because I think that the perspective around those credit metrics is very different when you own the downside risk and have to absorb those losses. So, in a general sense, what we see from these loans is they tend to trade in a range of call it 200 to 400 basis points wider in yield than your more traditional jumbo or non-QM loans. And so what that means in a time like now, because obviously I've gone on without providing very specific information, I think much of the legacy production from 2020 and 2021, assuming that the collateral characteristics are call it cleaner conventional type loans, maybe something that looks a lot like your normal jumbo production, but is a lower balance and still a conventional loan. We see that stuff trading in the mid 70s to 80s, depending on the note rate and some other characteristics. Whereas if that very same loan were originated 3 months ago and you're showing me a note rate that has more like 6.5% or 7%, you're going to be expecting a bid in the high 90s. So in almost all cases, when you're selling in the scratch and dent market, there is going to be a discount versus where you would be selling these to the agencies or your intended investor. But depending on what the actual loan level characteristics are, that could really be the difference between something where you're getting 97 or 77.
Gotcha. And so got one question for both of you, because we're going to be running out of time here. But so from a demand perspective, or where you're seeing these repurchase requests, and again, approximate percentages, and we're not going to name names, so you can name Fannie and Freddie if you like. But from repurchase demands, are you seeing more from aggregators these days or more from the agencies? And James, maybe I'll start with you and then go back to Mike to wrap this up. But are you seeing more, what are you seeing these days?
Yeah. More from, it's always been the case in my experience, more from the agencies. It's just whether, they come direct to you or they trickle down through the aggregators first. A lot of the aggregators are starting to, be much quicker, maybe even before they go to the agencies. But, again, most of them are coming down from Fannie, Freddie, and I won't, obviously get into the other names. And I will say just one thing that I was going to say, that one thing that we have seen, and this kind of goes back to the contract issue, is that if you underwrite for something that's supposed to be sold to Fannie and the investor chooses to send it to Freddie, and then they say, Freddie won't accept it. Well, I underwrote it for Fannie. That is an issue that could cause a buyback, even though you were under the assumption or understanding that it wasn't going to go someplace it did. So, that's something that you would want to address in your contract. But long answer to your question.
And so, Mike, from your standpoint, I guess you can tell by coupon, right? Are you seeing more 6.5s come through or 3s today? That would say.
Unfortunately, still the 3s. And, I think that to some extent, you're seeing some loans that, frankly, and I don't blame people, it's difficult to absorb that loss. So, we're seeing a lot more instances these days where maybe I'm seeing that same loan 2 and 3 times before someone ultimately decides to pull the trigger and sell it. But unfortunately, the reality is still a much higher concentration in the 3s than there is in the 6s right now. And, that results in a lot more bids in the 70s and 80s than 90s right now.
Well, great. We've got one more poll question for those CPE credits, and I'm sorry we've run people right to the top of the hour, but the final poll question is how are scratch and dent bids in 2022 compared to 2023 compared to 2022, and Mike's already answered it. It depends, but it really depends on the collateral type. And Mike, I don't know if while this poll question's up, if you want to expand any more on that, but it really is going to be the WAC and the characteristics.
Yeah, and even just related to this, I don't want to get anyone in trouble giving the answers to the test away beforehand, but I will say that we are seeing more bidders on each individual loan. We're seeing bidders priced to tighter discount rates. So, we are, well, I guess, beauty is in the eye of the beholder, because I would have answered better, but apparently, I'm not with everybody else. And so,
that's okay.
Yeah, I suppose
it's an ungraded quiz.
It's relative to the loans that there are. When you're looking at a 78 bid, it still looks very bad. It doesn't look better. Whereas from my seat, it looks a little bit better than it did 6 months ago.
James and Mike, I'd like to thank you very much on behalf of all our clients, Richie May, for your great wisdom that you provide to the folks on the call today. Thank you again for your participation. We loved having you on here. Hopefully for the folks on the call, you learned a lot more about the repurchase demand, the market, what to do, how to fight it, get involved early. You've got some experts here that you could reach out to on both sides to help you out. And with that, Gabby, I think we will close out this trend series for this quarter. We appreciate everyone. Here's our contact information. And again, if you got further questions or you want contact information for James or Mike, please reach out to us and we'll be happy to provide that to you. Mike and James, again, thank you for your time and wonderful information, and everyone have a great rest of your day.
Hey, thank you very much.
Thanks, everybody.
Thank you. Bye.